What's up, good people? My name's AJ, and I'm coming at you with a video here today about the factors that affect and also how to change or improve on your FICO score or your credit score. And whether you've been developing your credit for a little bit of time or you're just starting to build your credit, these are the main factors that go into the calculation, but also a couple tips that I'll offer on how you can improve these things. So most people know this one, but the number one factor that goes into calculating your FICO credit score is your payment history. I won't get into budgeting or, not taking out loans that you can't cover too much here because of course those things are extremely important, and not biting off more than you can chew financially is maybe the most important thing you could do. But specifically for your credit score calculation, what they're looking at is a percentage coverage of the total obligations that you've had in your life and what percent of those payments you've made on time. It's a pretty easy math problem. This factor makes up just almost about 50% of your FICO score. And, the answer is 90% or 98% or 100% of the payments that you have had to make throughout your credit history. What percentage of them have been made on time? And the best way to improve on this is to not miss any payments. So there are a couple things that factor into that. The main one is budgeting. Usually if you have the money in your bank account to make a payment that you need to make, you're going to be able to make that payment. So that's the one I said I'm kind of going to skip over here. I have other videos on how to keep a good budget. But, the second one, and actually you might think it's uncommon, but it's one I ran into myself. And also I know pretty successful folks who I've heard speak about this have also ran into in their own credit history. And that's missing a payment, forgetting to make the payment, thinking an auto bill was set up, or making a double payment 1 month prior and then thinking that your next month would be covered by that previous larger payment. You need to be very diligent when you have lines of credit out. If it's just you have one line of credit, it's student loans, or if you own a house and you have cars and credit cards and other things and you have 10 lines of credit, I think the best way to do it is pick one day each month. For me, that's the 20th of each month, and log into my different credit providers and websites that I make payments through the financial institutions with, and make sure that everything gets paid every month. And that's, honestly, as long as you have the money in your bank accounts to be making those payments, you need to be taking the second step to never have any mishaps and keep that payment history number up near 100%. Now, the second one, and this is a pretty major factor as well that goes into calculating credit score, has changed a little bit throughout the years, or people's interpretations of it has changed a little bit. And that is either your total amount of debt, or what more recently I think is a better understanding of that calculation is credit utilization. Of course, amount of debt would just be, what is the total amount that you owe? Say you have 10 grand on a credit card and a $40,000 car loan, amount of debt's 50 grand. Boom, there you go. Credit utilization, though, is, by my understanding, really what the credit agencies look to more directly when calculating this amount of credit score. And it differs based on how much credit is available to you. So, the best way I can illustrate this is if you owe $2,000 on a credit card, but your credit card limit is $5,000, you are 40% utilized. But if you owe $2,000 on a credit card and your credit card limit is 10 grand, you're only 20% utilized. That helps your number out, your credit utilization number out, or your amount of debt pretty substantially. So what I've done to improve my own credit score is just gone into my credit card issuers and say, hey, can you increase my maximum on my card? So for me, if I pay $3,000 a month in bills off on my credit card, my old max was 15 grand or whatever. I got that doubled, I think, to about 30,000. I don't even know what it is, but it really improved my credit score the following month because my credit utilization percentages went down. So don't just think of this second factor as the total amount of debt that you owe. That's not exactly what goes into the calculation. Your percentage utilization of the available credit to you is also fairly important. The third one isn't all that easy to manage if you're someone in your 20s, and that is the age of your credit. This is the worst or the relative worst component of my credit score. So I think the average age of my loans is 2.5 years right now, or 2.4. And that might be considered mid-range, good or something. But it's definitely not great or excellent when calculating what your FICO score is going to be. And there's no quick way to improve on this. Of course, the age of your credit just ages with time. So as you wait this out throughout your 30s and 40s, your average age of your credit is just going to grow. There are two good points to mention here that can help you improve on them. Number one is start earlier. So people say get your first credit card when you're 18 when you can. That's always a good tip. If it's something that you're going to be carrying for a longer period of time, whether it be student loans, maybe a car loan, anything that could potentially increase without putting yourself into a personal situation where you can't financially cover the payments that you need to be making, if you can do things that are going to extend the average age of your credit throughout your 20s, that's going to be a beneficial factor. And the second is where I think most people can make a difference to how they manage their own credit score, and that would be not paying off your bigger or longer loans sooner. Makes sense if you want to increase the average duration of your outstanding credit lines, and say you have a card payment that you've had for 4 years and a student loan payment you've had for 8 years, and you want to pay one of them off because you have an extra $5,000 that you can do for that now. Aside from the interest rates and the actual payments that you're making onto those loans, because those could be totally different stories, but just in terms of improving the average age of your credit to help your FICO score, pay off the one that hasn't been outstanding as long, because once that debt is gone, it's going to fall off your credit history and it's not going to be factored into the calculation for the average age of the credit that you have. If you can pick between a loan that you haven't had for all that long and a loan you've had for a longer period of time and paying either of those off, to improve on this metric, you want to be paying off the one that you haven't held as long, so that you keep that longer term loan or the loan that you've held for longer on your credit history, so that the average age of your credit continues to be a slightly higher number than it would have been relative to that shorter term loan. The total number of accounts that you have or lines of credit that you have, so these can be auto loans, mortgage, student loans, credit cards, home equity loans, is another factor that the credit rating agencies are going to look at. Now, I'm hesitant to directly mention that everyone should have more lines of credit, because for a lot of people, they can get into trouble when they have more debt available to them, whether it be through credit cards or personal loans, and they put themselves in a situation where they can't cover their monthly payments anymore. And that is the worst case scenario, because you're going to hurt number one, which was your payment history coverage percentage. But if you start to get to the point where you say, hey, I could grab another credit card, or hey, I could put a vehicle loan on this car that I would have maybe bought with cash for $3,000 or $5,000, but it really wouldn't bother me all that much to make a $200 a month payment or whatever it would be, having an additional line of credit or piece of credit or credit account on your credit report is going to improve that metric. And finally, you have your credit inquiries. Luckily for people in our 20s, this factor isn't weighted all that highly into your FICO score calculation, because I think a lot of us have a pretty high number of credit inquiries, which is not good. So anytime that you are shopping for a loan, whether it be through a car, you're refinancing student loans, or applying for new credit cards, those all count as credit inquiries. And actually, there are more things out there that you'll do financially that count as a credit inquiry outside of the few that I just mentioned. And the ones that I just mentioned are the ones that people generally understand to be credit inquiries, but a lot of the other ones, you won't know that your credit is getting tapped into or checked until you check your credit score, 6 months later, and you say, wow, I didn't know that I had 6 credit inquiries in the last 6 months, and you didn't even buy a new car or something like that. So be careful about the types of things that can end up being a credit check or a run of your credit score, because as these credit inquiries start to add up, it will hurt your FICO score just a little bit. But again, luckily, this isn't the primary calculation into calculating the score, because I know for younger people, a lot of us with refinancing and moving around, maybe buying homes, throughout that period of your life, you just end up having a lot of credit inquiries. Well, there they are, folks, and a few of the tips that I think you can use to hopefully improve your credit score. Let me know in the comments if some of these work for you, and thanks for watching.